The next two metrics that we are going to look at are sister metrics. It's ROA and ROE. They stand for return on assets and return on equity. Now, a lot of people kind of think of these as the same thing or like just different ways to look at the same thing, but they are actually two very separate metrics. And we are going to go through each of these metrics. The first is return on assets. Return on assets measures how profitable a company is compared to its assets. So if you have a bunch of assets and you are making tons of money, well then that's fantastic. That means you are using your assets wisely. So it's measuring how profitable a company is compared to its assets. Now there's also ROE, return on equity. Well, that's measuring how profitable a company is compared to its equity. Now, you might be thinking, okay, well, those sound kind of similar, right? Like one's just measuring assets and the other equity. So what's the big deal? Like, I feel like that's kind of just looking at the same thing in different ways. Well, it's not, and we'll get to that in just a second. So let's first talk about how we calculate ROA and ROE. To calculate ROA, we take the total net income and we divide it by the total assets. Now, I recognize that net income is not the best measure of profitability, but this is sort of the generally accepted way to do ROA is to take net income and divide it by total assets. Now, to calculate ROE, return on equity, we take net income and divide it by the average shareholder's equity. So let's go ahead and look at an example. Let's just say a company had $1 million in assets and net income of $125,000. Well, that means the ROA, the return on assets, would be 12.5%. And how we calculated that was we took the $125,000 of net income and we divided it by the $1 million of assets. So, the general rule, and this is going to help explain the difference between ROA and ROE. These ratios seem very similar, as I mentioned before, but they tell you two very distinct things. And what separates the two of them is debt. So just remember the accounting equation, which is assets equal liabilities plus equity. So that means if a company has zero liabilities, so it has zero leverage, then that means that the ROA and the ROE will be the exact same number. So remember the equation, assets equal liabilities plus equity. Well, if liabilities is zero, that means the assets will equal equity. And at that point, then ROA will equal ROE. So at that point, they'd be the exact same number. However, when a company takes on leverage, it increases assets while decreasing the size of its equity stake. So just remember, if before I had $1 million in assets and $1 million in equity, but then to buy another $1 million of assets, so now I'm up to $2 million in assets, I took out $1 million loan. That means I'd have $2 million in assets, $1 million loan, and $1 million in equity. So that means on a relative basis, equity decreased compared to assets. So in other words, how we can think about it is debt is supercharging ROE, return on equity. And how it supercharges it is the numerator, which is net income, stays the exact same in both equations, while the denominator becomes smaller. So if a company is highly levered, if they have a lot of debt and not a lot of equity, then the ROE will paint a rosier picture than what is actual reality. So by using ROA, you can kind of see the full picture. So it's kind of two parts of the coin. One, ROA, you can see how the assets are being utilized, and ROE is kind of seeing how the debt is being utilized. Alright, so after that explanation, you are probably completely confused. You're like, alright Nate, you completely confused me. Show me an example. Alright, let me show you guys an example of what I'm talking about. Let's say that you have a company and you have net income of $10,000. And at your company, you have zero leverage. So in other words, assets of $100,000 is equal to equity of $100,000. And you have zero liabilities, so you have zero leverage. Well, in that case, ROA and ROE would be the exact same thing because you're taking $10,000 divided by $100,000 for ROA, and and that gets us 10%. And then we're taking $10,000 divided by $100,000 to get ROE of 10%. So it's the exact same number. However, let's say that we introduce leverage into the company. We take out some loans, and suddenly we now have $50,000 in liabilities, and it reduces equity by $50,000. So now assets remain the same at $100,000, liabilities increase to $50,000, and equity decreases to $50,000. Well, watch what happens to ROA and ROE. Well, ROA remains exactly the same. We took the $10,000 and divided by the $100,000 in assets, and we get 10%. But look at what happened to ROE. It doubled. It went from 10% to 20%. Because we're taking this $10,000 and dividing it by a smaller base. And because we are dividing it by a smaller base, we are supercharging that number. So ROE went from 10% to 20%. But here's why both metrics are necessary. Sometimes people only look at ROA or only look at ROE. Well, they are missing a huge piece of the puzzle. You need to look at both because you can see how efficiently a company is using its assets. In this example, whether we had leverage or no leverage, the company did not increase the efficiency of using its assets. It went from a 10% ROA right here to a 10% ROA down here. So they didn't do anything better. They didn't improve the efficiency of the company. Now, don't get me wrong, they increased their ROE from 10% to 20%, but the only reason that metric went up is because they loaded themselves up with some debt. They went from zero debt to $50,000 in debt. So ROA is telling you how efficiently you are using your assets. You are doing a fantastic job. You're doing 10%, next year went to 12%, next year went to 15%, so you're doing a good job. ROE is telling you kind of how much you're supercharging your returns by using debt. In this case, we didn't become any more efficient because we got debt. In fact, now that we have more debt, our company almost becomes more risky because we have more debt that we need to service, but we didn't really increase the efficiency of our assets. So you want both of these numbers to be increasing at the same time. If you ever see ROA stagnating, but ROE increasing, well, that means you're using debt to supercharge your returns, but you're not becoming any more efficient, and that's not a good thing. So let's go ahead and go back into our spreadsheet and calculate ROA and ROE.